Hey everyone, I'm Anita Sharma. Welcome to Market Call on BNN Bloomberg. Andy Bell is on the morning shift today. David Burrows is with us on the program. He's the president and chief investment strategist at Barometer Capital Management. He'll take your calls, emails, and tweets on North American large caps. The conversation continues. 1-855-326-6266. Our email address, marketcall@bnnbloomberg.ca. David, what's going on?
Well, I'm glad to be here. It's
always great to have you here. Market's a little, I don't want to say they're under pressure, but the Dow, like yesterday, folks taking some money off the table. It's been interesting. We've got some big retail news coming out today. Target up a nice, last time I checked, up about 11%. Lowe's also doing a lot better than expected. It's nice to see as far as retail goes. You're confident, right? Heading into the end of the year. You're not expecting Scrooge. You think Santa's going to make a comeback, right?
Yeah, so, when I was on in January this year, we noted that certainly the end of the year was extremely weak. And that was certainly discounting some slowdown from Fed hikes and otherwise, but that it was likely a mid-cycle slowdown and that it was a correction in a bull market and that was likely to resume this year. And that was based on a number of things. But here we are now, 10 months later, 11 months later, and we've taken out the highs from 2018. Importantly, some very economically sensitive groups like semiconductors and railroads and financials have made new recent absolute and relative highs versus the market. Those are not signals of recession. So I have more confidence today that we have continued into this bull market. And just like we corrected through 15, 16, we corrected through 18, and now we likely have a full leg in front of us, another 24 or 30 months.
24, 30 months. All right. We've had some bulls on the program. That is very, very bullish. As of late, the folks I've spoken to have said, you know what, definitely going through the early part of 2020, perhaps near the end of next year, we could see the bulls really dominating. But beyond that, folks are not confident making predictions, especially since we've had the inverted yield curve situation transpire for the better part of 2019 earlier this year. And I guess the general thesis on that, hold on, the general thesis on that is that, it takes 18 to 22 months. I'm getting David going here. It takes about 18 to 22 months to really see the impact of that come through. And then once again, the R word flashes, right? A lot of folks are saying those signals are flashing. What do you think?
Look, we are cautious by nature, okay? We dodged 2001 and 2. We dodged the financial crisis effectively. We dodged 15 and 16. However, there's a time to be more aggressive and a time to be more cautious. When you are 3 Fed cuts in, and when you are getting the signaling that we're getting from economically sensitive sectors, it's telling you the market is looking through early year weakness and to reacceleration. And, we have a series of breadth models that we use to track what is happening, and we have no problem getting defensive if that starts to change. But the signaling is quite strong right now. Now, that happens against a marketplace where investors are not positioned for this, right? We've had 18 months of time to worry about Trump and about Russia and about China and trade. 18 months of volatility where people took their views and helped them to reposition their portfolios for what they thought would be a slowing economy. There's $1 trillion that's hostage to the market in equity portfolios. It has to be there. And a lot of that moved into highly defensive sectors, utilities and telcos and REITs.
For sure.
Things that would lose less
if
the market went into recession. And those trade at 2 to 3 times historical multiples. And cyclicals trade at basically the lowest multiple since 1980. And like in early 1995 when the Fed started cutting rates, and they had a mid-cycle slowdown, definitely weaker data in the first half of that year. It reaccelerated, market rallied 95, 96, 97 into 98. So we believe we're in a secular bull market. We've been through a constructive, though painful, correction in 2018. And we likely, if you look at history, of the 13 sort of bull cycles in secular bull markets since 1950, the average length was about 31 months, magnitude about 90%, and certainly the right sectors did a lot better. So I think that we're headed into we're in the seasonally strong period of the year. Breadth readings are very strong. It looks like global PMI data bottomed in July. And I think that we are set up for a good run in front of us.
Very quickly, it marries the thesis of Goldman. It came out with its outlook, I believe, last Friday, and they essentially said all that juice that the Fed's been providing for the market, you're going to see, they're not going as far as you are, as far as, 18 to 22 months out, but they're saying that there's definitely enough juice for the market to see equities really make a big run for at least the better part of the first quarter, at least, of 2020.
So just think of it this way. We've been through some slowdown, yet the U.S. has the lowest unemployment in 50 years. So any reacceleration is going to cause wage growth, and it's going to give companies an ability to raise price. And that's exceedingly positive. Now, the Fed and 13 other central banks are easing, and they have said implicitly that we are willing to sanction more inflation than we typically would.
Mm-hmm. Correct.
So that means they're going to be accommodative and will take longer to start raising rates, which probably extends the runway for the market in the near term.
Okay, you're setting up our show beautifully, David. Thank you for that. We'll come back with David Burrows. He's the president and chief investment strategist at Barometer Capital Management. We're on North American large caps. Get your calls in. We're taking them next. 1-855-326-6266.